Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Market 5. I'm your co-host, Joel L. Connon, along with Brianna Valesky, and we have Gary Kaltbaum on the line. He's the president of Kaltbaum Capital Management. Gary, how you doing in this scary market?
We're in cash and just looking to short things on the bounces. They're getting the pretty ladies now in the market, and that is the Googles and the Amazons and the like that have held up, some of the major indices. And to me, it's just a process that continues of nausea, and you really got to stay out of the way if you want to be long.
Really? And, I sometimes get in trouble shorting the stocks that have held up pretty well. Because sometimes I find up, they held up for a reason. You just think that now they're being propped up, that there's just too much overall, negativism in the market.
Oh,
Yeah?
yeah, absolutely. Look, how bear markets work is there's always a certain group or two that hold up best, and in this case, it just amazingly turned into a select few great growth names. I'll just give a few names out. That's Skechers, Facebook, Google, Amazon, the auto parts retailers like AutoZone, Starbucks, and things like that. And typically, always, they end up getting them also. And what you use to know it is the 50-day moving average.
Okay.
Once they break that level, it's time to just run away from them, because in this market, when the market gets something, they pretty much get it good. And what's interesting is on Friday, I saw this coming, so I wrote a note over the weekend that I thought they were about to get the Amazon's. I mentioned Priceline, which was down 50 or 60. And it's just because, just remember, the money that's been buying these things up and holding them up is not real buying. It's more like parking of the money. Big mutual funds that have to be fully invested always have to move money around. And when you get into bearish markets, it's got to find a place, and it usually runs to the place that's holding up best until finally that caves in also under the weight of all the ugly that we're seeing. I think we got that yesterday. We're already oversold in one day on these areas, so you're going to start getting some real wild bounces, but I think ultimately they will go lower.
So how do you like to go and just short the equities outright? Do you try and do it via options? Do you try and layer into things? What's your approach? Because shorting is tough, and not a lot of people.
It's a pain in the rear end. Just realize your best rallies are in bear markets, and that's because they're mostly short covering after oversold, after drops that become oversold. And what I tell you, all your listeners to look at, go see where every one of the major indices hit on that Fed Thursday. It was the declining 50-day moving average. Number one bear market characteristics is that rallies will run into a now declining 50-day moving average and fail right there. You will take a look at the Russell, the S&P, the biotechs, just about everything on that Fed day when we rallied up initially, hit it and sold off. Now, everybody's given blame on why we're selling off to the Fed not raising rates. That's insane. We sold off because we're just simply in a bear market for stocks, and that's where the big money usually sells into. And for anybody to think that it's be good news to be raising rates into a bear market,
Yeah.
I got some straitjackets for you. So unfortunately, the Fed has it backwards right now.
And I was just scratching my head on Friday because, a hawkish talk out of a Janet Yellen, and they take the spoos up 25 handles. I'm just like, what is this? What's
look, that's just the reaction in an oversold market. You can't really look at it more than the trees. The forest is we're in a bear market for now. And look, just to take an aside about Janet Yellen and the Fed, she told a fib during her press conference on that Thursday that they are not looking at markets. It is my contention that's all they are looking at. And when markets reacted negatively to them not raising rates, they thought, well, the opposite is we should just raise rates. So all of a sudden you're hearing them being hawkish. But the bottom line is the market right now is like any ex-boyfriend or ex-girlfriend you had in college that broke up with you and doesn't even want to hear from you anymore. The market is telling the Fed, go away, we don't care, all your talking and all your moves do not matter, and because we're in a bear market for stocks, and that's the end of it. The only thing that can potentially change is if the Fed comes back and announces a quantitative easing number 4, more printing of money. But I think at this point in time, that would only have give us a 500,000 point pop, and they'll just sell it right back down again. Because just remember, bear markets are just what they are. Bear markets, and good news is bad news, and bad news is even worse news, versus bull markets. Good news is great news, and bad news gets bought up. So I think you got to be very careful. The rules have now changed because we're in a different environment than what we were in for 5 to 6 years.
All right, looking at the catalyst here for this decline, I mean, I don't know if you want to go China. I mean, the thing that really put some fear in the market yesterday was this whole thing going on with Glencore, and
Yeah.
boy, oh boy, I mean, you also have to think about who's on the other side, of their money or their bonds
Yeah.
and their trades. This could have a huge spillover effect.
Yeah, well, look, bear markets tend to cause the bad news. And as I said, bear markets are either going to cause the recession or they're forecasting the recession. What you're going to see now is very simple. Due to the fact so many things were positive because of higher asset prices, lo and behold, you're going to start to see a lot of negatives of asset prices. Number one, there's nobody going to be able to do secondaries anymore. You have all these biotechs with no sales. Let me repeat that. No sales that were brought public in the last 2 to 3 years, cashing out left and right. I know a couple of biotechs did 5 secondary offerings in the last couple of years, and the price of the stock still went up. That's over and done. So you're going to see cash burns in these biotechs that have nothing going from and should never been brought public. That's number one. Number two, with the lower energy and oil prices, you are seeing massive drops in the debt of a lot of these companies. So that hurts the junk bond market and will overflow into other areas also.
Back on the line with Gary Kaltbaum of Kaltbaum Capital Management, very cautious on the markets. We were discussing the situation with Glencore. He was sharing his insights on the Glencore business operations.
Yeah, look, what everybody has to realize, higher asset prices always causes positive news, so lower asset prices is going to cause negative news. In the last few years, you have had biotechs with no sales. So let me repeat that. No sales, not no earnings, no sales come public, and they have the ability. I know one company did 5 secondary offerings. That ends. That's over. That's done. So you're going to see a lot of cash burns in these biotechs, and look out below. You have seen in the debt markets a lot of riskier energy companies go to the debt markets in a very, very big way. That's ending now, but you see what's happening with energy prices. You've seen massive buybacks from companies throughout the last couple of years. Unfortunately, it may turn into buying back at the highs again. That ends. So all the things that basically help asset prices higher will end, as if this continues, you go from a great virtuous cycle to a vicious cycle, and that's what simply bear markets do. And again, it's very important to just hang back right now and see how this plays out.
What about these dividend stocks? Your GEs, your Johnson and Johnsons, your Procter and Gamble's, your AT&Ts. I mean, any safe haven there with the dividend yield?
No, but they will hold up better than most. But then again, you look at Procter and Gamble; it's already gone from 94 to 70, so that's not such good news. But typically, what will happen in bear markets as we work through them is that they will go after the beta a lot more. That is your high flyers. They'll have the biggest losses eventually, and there'll come a point in time where you get to recognize that more than likely the utilities, the food, drug, beverages, which are on the tobacco, which are on the recession-resistant side, they'll hold up better. I would not play them based on dividend, because if you buy something that's paying 4% and it drops 15%, you got a total return of down 11%. I'm always a big believer that bear market's best place to be is cash, and just like bull market, the tops in bull markets as well as bear markets give you clues, the ending of bear markets will give you clues also when to get back in. And look, I'm amazed to see so many people, after already down for only about a month, calling bottoms already. That is normal for bear markets, but I never seen it in the first month. I'd be careful. I am not saying that tomorrow the market does not bottom. I'm just saying that all evidence in right now, this is nausea at its highest level, and you will get run over as this continues. So, I have to mention, I was asked about this possibly being 1998 yesterday, where you had these two big double bottom, you undercut on the second low, and then we just lifted off for another couple of years. I will say it kind of sort of looks like it, but I just don't believe you top out for 6 to 12 months and then all of a sudden turn back up after a month or two. So I think you just better be careful, and if things change, I will change with it, but so far the market's playing into the hand.
So the target is that flash crash low. I mean, think about it. The way I'm looking at it is, if we come back down there again, I mean, yeah, you might get an intraday pop or something, but I think we come down there again. I mean, it was just like too textbook that we're going to come down, double bottom there, and go back up. I mean, the markets never do what you expect them to do.
Well, I don't think that's happening, but I'm open to anything. Markets are an inanimate object that will do what they want to do regardless of what you think. But I will tell you, the Russell 2000 has already broken that day, the low. So you already have one index doing it. And I suspect we may get a little defense here. We'll get a bounce up. But I've seen nothing good. And let me just say, all that's going to happen, I'd say, in the next couple of weeks is a bunch of backing and filling. The moving averages that are now above you have to catch up on the downside, and as markets bounce or rally into them, or they come down to meet, that will be your next point to either short or get the heck out. And look, once we break the lows, we'll finally hear the masses say the two words, bear market, because we'll be in the 20s, and that's where I think more margin is going to be a problem. Just remember, the biggest problem for bear markets is the margin that's created in the prior bull market, and we went to records again, and even though margin has dropped recently, there's still a massive amount of that leverage still to come off. So that's not going to help. That only exacerbates the situation also. So I wish I had good things to say. The only thing I could say good is that short term, which is the trees, and it really is on a 1 on a scale of 10, we're going to bounce probably a little bit. And Amazon that drops 20-something in a day may bounce a few bucks, but I think that the die has been cast here, and I think you got to be really careful or else.
Gary, do you see any pockets of strength, any leading stocks in the bear market?
Not yet. And look, I scan 2,500 to 3,000 names every night. And coming into this week, and I put in my report, it's at GaryK.com, I put a paragraph in there over the weekend saying I think they're going to come after Amazon, Facebook, Google, Priceline, and some of these other what I call glamour names. They got them also. And people are thinking, well, since they got the glamour names, that's good news. I'm not so sure that's good news. So as of this second, I'm not finding anything that's showing bottoming type formations. I can say the utilities are going to hold up better here, and you can see utilities have already been hit pretty hard. So I think that may be an area that if you had to be invested, you can park some money. But after that, I'm sorry, I got nothing to tell you here at this point.
What about any potential shorts?
Not this second, because we've come straight down since Thursday. But I can tell you, and let me put it best, on rallies back into moving averages in the next couple of weeks, I think you can throw a dart on the short side again. Bear markets usually have 3 waves down. I think we just only finished number 1. So, again, I think you're careful, got to be careful here and recognize, and let me just say something important here, that so many people think it's the end of the world. Oh my goodness, it's a bear market. Bear markets are supposed to happen. They happen all the time. It's just unfortunate that central banks have created big bear markets because they've created asset bubbles with their asinine easy money policy. And the worry now is that the easy money policy that we've had over the last few years is easier times a million than we've ever seen. So I don't know what's on the other side of the door, except to say we're in a bear market right now, and until that trend changes, you better go with it, or you're fighting. You're like walking into a 200 mile per hour wind thinking you're going to get some headway.
We've been on the line with Gary Kaltbaum. He's the president of Kaltbaum Capital Management. Gary, thank you so much for joining us this morning. You're quickly becoming one of our favorite guests on the show. We'll have to bring you back very soon.
I wish I had better news for you, but that'll come in time. And let me just finish up. The great things about bear markets is they always lead to new bull markets, which will spawn massive gains if you have a keen eye for it. And I can promise you I'm going to be ready, working my tail off to make sure I'm on it when it comes.
A light at the end of the tunnel. Thanks, Gary. We'll talk to you again soon.
All right, take care.